Okay, let's talk venture capital. A great story might get you in the door with a VC, but it's the math that's going to close the deal. So today, we're going to break down the two numbers that are at the absolute heart of every single investment decision. It's this constant battle between how much money you make versus how fast you make it.
All right, section 1, the deceptive multiple. We're going to dive right in here by tackling one of the biggest, and I mean biggest, misconceptions in all of investing, the simple return multiple. So let me ask you a question. Is a 3x return always a home run? I mean, think about it. An investor tells you they tripled their money on a deal. Sounds amazing, right? An automatic win? Well, the answer might actually surprise you. And here's where intuition just gets totally flipped on its head. Look at this. That 3x return on the left, it sounds incredible, doesn't it? But stretch it out over 10 long years, and its annualized return, that's the IRR, is only 11%. That's barely better than just sticking your money in the stock market. Now look over at scenario B, a smaller 2x return, but in just 4 years. That generates a way more powerful 19% IRR. That right there is the speed, the velocity of capital that investors are really hunting for. Okay, next up, speed versus scale. So to really get why that faster 2x return is actually the winner, we've got to look at two key metrics. They're really just two sides of the exact same coin, speed and scale. Okay, first up is something called MOIC. That stands for multiple on invested capital. And honestly, the best way to think about this is like the odometer in your car. It just measures the total distance you've traveled, or in this case, the total value you've created. It doesn't care how fast you got there. So a 3x MOIC just means your $1 turned into $3. That's it. It's pure scale, and it literally does not care if that took you 1 year or 20 years to do. So if MOIC is the odometer, then you've probably guessed it. IRR is the speedometer. This is your internal rate of return, and it's all about the speed of your investment's growth. It's an annualized rate, which is just a fancy way of saying that time is a huge factor here. It answers that all-important question, yeah, but how quickly did we actually make that money? And that, right there, is why that 4-year deal had a much better IRR than the 10-year one. So let's just put these two side by side to make it super clear. MOIC asks how much. It's all about the scale, the total value. IRR asks how fast. That's all about capital efficiency, the speed. You absolutely need both to get the full picture, right? Because one tells you where you ended up, and the other tells you how fast you got on the highway to get there. Okay, next section, visualizing the trade-off. So the really crucial question is, how do you actually manage this trade-off in the real world? Well, investors use this brilliantly simple tool that makes this whole relationship just instantly clear. And the solution is honestly beautifully simple. You just map time against returns. That's it. Instead of trying to do all this complicated math in your head or just guessing, you lay it all out visually. Let's take a look at what that actually looks like. Okay, check this out. This is an IRR grid, and it makes that trade-off we've been talking about crystal clear. See, on the left, you've got your return multiple, your MOIC. And then across the top, you have the number of years it takes to get that return. You can see right away how time just destroys returns. For example, a 5x return in year 3, that's a massive 71% IRR. Amazing! But if that same 5x takes 10 years, look at that. Your IRR plummets all the way down to 17%. VCs practically live by grids like this because it tells them in a split second if a deal's timeline has any chance of hitting their fund's targets. So why does all this math matter? Let's get into it. Because I promise you, this is not just some academic exercise. Getting this math wrong has real, and I mean very expensive consequences for everyone involved in a deal. I mean, think about the risks if you ignore this stuff. For founders, you could totally underprice your funding round, leaving a ton of money on the table. For VCs, you might set these super unrealistic goals, which ends up eroding the confidence of your own investors, the LPs. And really for everyone, it just means wasting months and months on a deal that looks good on paper, but can never ever deliver the speed that's actually required to be a success. And this is why mastering the math is so incredibly powerful. There's this great saying in the industry, good financial preparation will always win the room. And it's so true. When you can walk into a negotiation and you truly understand the IRR implications of your pitch, well, you're not just asking for money anymore. You're proving that the numbers actually work. And that, my friends, builds an incredible amount of trust. And you know, the best part is the process for using this insight is super straightforward. It's really just 3 steps. First, you just drop in your data, your investment parameters, your target multiple, and how long you think it'll take. Second, you review the auto metrics. You can just scan that grid we looked at and instantly see which scenarios actually clear your IRR target. And third, you decide and share. You use those insights to negotiate your valuation, to plan your exit strategy, or just to update your stakeholders and keep everyone on the same page. Simple as that.
All right, let's bring it all home. Mastering the narrative. So what is the big takeaway here? It's pretty simple, really. You take control of your story by mastering the numbers that back it all up. The bottom line is this. In the world of venture capital, you don't just sell a story. You have to sell the math that's behind that story. Truly understanding this trade-off between speed and scale, between IRR and MOIC, it allows you to speak the language of your investors. It lets you make faster, better, and way more defensible decisions. It's really how you move from just guessing to actually knowing. So, I want to leave you with one final question to think about. This whole dynamic, it's not just for venture capital, right? So think about it for a second. Where else does this fundamental trade-off between speed and scale define what success looks like? Maybe in other parts of business, in technology, heck, maybe even in your own career. It's something worth pondering.